Another guest now, Arindam Ghosh, the MD and CEO of Blackridge Capital Advisors, joins in on our discussion about what to expect from the budgets tomorrow. Hi Arindam, thanks so much for joining us on the show. The market has been quite oversold in the run-up to the budget, but according to you, what can send the markets up on budget day tomorrow?
No, I think if one has to really go by the economic survey which has been rolled out today, what it has done in the short term is it has managed to kind of uplift the kind of gloom and negative sentiments that we have seen over the last couple of weeks. Of course, one needs to go beyond and look at how the budget is kind of accepted by the market tomorrow. But clearly, I think going beyond, we need to understand that there are structural issues which limits maneuverability on the policy front. Clearly, with inflation and fiscal deficit being among the highest in the emerging markets, India cannot really adopt a very, very aggressive fiscal or monetary stance. So, and also if we combine the fiscal slippages that we have seen in the past along with the widening current account deficit, and if we also look at issues around land acquisition, issues around environmental aspects, the supply side bottlenecks in mining, the fuel linkages, etc. I think a combination of all these factors is what has actually been marking the growth down. So I think whilst we have actually been riding high on the orbit of about 8% plus growth, I think 5%, 5.5% kind of growth for this year, and a modest recovery which would probably take us to FY12 levels of 6.5% is what is expected. So I think all attention would be on what kind of numbers are actually spelled out, and the maths that goes beyond these numbers. Having said that, I feel that as far as the fisc is concerned, I think the focus of the government is going to be clearly on how do we achieve greater fiscal consolidation, and for the moment I would say that the rub of the green would go in favor of the fisc rather than on growth.
Arindam, hi, afternoon. What are you expecting in terms of any sort of impetus towards capital gains, or rather encouraging FII inflows rather into the capital markets? Can you hear me, Arindam?
Yeah, I can hear you.
Yeah, my question was with regards to any sort of impetus that we could expect, possibly, on short-term capital gains tax, or maybe STT revisions or CTT, anything in terms of increasing the impetus of FII inflows into capital markets?
Well, I think we've seen a fair amount of decibel level getting raised as we are getting closer to the budget in terms of removal of the short-term capital gains tax, and I think there are clearly the world is kind of divided. Personally, I feel that that would really give a lot of boost to the markets. One can really argue that it will probably change the behavior of investments. But if you look at worldwide, even the 401k, which kind of builds a discipline around investment, has come under a lot of criticism. So I think a stimulus or an impetus cannot be on the back of tax for a very long period of time. Structurally, I think we've had tax incentives trying to boost growth for a long period of time, but it is at the end of the day performance which actually matters, and therefore I think removal of the short-term capital gains tax or lowering the STT is something which probably can really ignite and flare up the markets.
Okay, so if you had to put it into perspective for us, Arindam, what does all of this amount to in terms of an equity market movement itself? Because in the last couple of weeks, we've seen the markets move lower, and one was worried whether we would get back to those 5,500 levels that we saw, towards the end of November, December. Do you think that could be on the cards if this budget is not delivered as promised, or do you think there's only upsides in store for the market now?
No, I think we need to kind of look at both the domestic as well as the global issues. I think aside of the fisc and the GDP growth numbers that is going to get articulated in the budget tomorrow, we also need to keep a close watch on how inflation actually pans out. And whilst The survey really talks of a much more benign inflation environment, and we all know that WPI, which includes core inflation, is kind of tapering off. But we must understand that CPI continues to remain very stubborn, and in a country like ours, transmission from food to non-food doesn't really take very long. So the whole issue is whether WPI can be sustainable, and therefore how inflation is going to really play out, what kind of room it will allow in terms of maneuverability to the central bank, in terms of monetary easing going forward. So I think that is going to be keenly watched. Of course, we also need to take a look at the current account deficit and how that's going to get managed, because whilst the government has been taking a lot of efforts around trying to get in long-term investment through FDI, they are also trying to cut subsidies, trying to promote inflows into the market, but these are very fickle. We have to really focus on capital formation, and that can really happen if you focus on domestic manufacturing. We've already seen the curbs really happening in unproductive imports. And we really cannot expect too much to happen in terms of export in an environment where there is a global slowdown. Now, moving away from the domestic factors, I think globally, if you see, the situation is much more benign, right? Today, we have an US which is kind of getting supported by a favorable financial environment. The household sector is recovering, which is allowing the households to repair their balance sheets. But the joker in the pack is clearly the Eurozone, and that's where we see the biggest downside risk to global growth, and that is where we would like to see how reforms in terms of a full banking union or the fiscal integration that is being debated and talked about for quite a while actually plays out. If you move to Asia, of course, we have Japan, which is kind of been in some kind of a recession. But that's not really causing too much of an anxiety, because we know that they have enough room and firepower both on the fisc as well as on the monetary side. And I think once we have the trade resumptions happening with China, I think all of that will also fall in place. So I think the global environment is much more benign. So going beyond budget and going beyond what is really going to happen tomorrow, as long as I think India is able to put up a credible budget backed up by solid execution, I think the rating agencies are going to take it quite positively. And India, in an environment where liquidity is what is really pushing up and driving the equity markets up, is going to continue to remain one of the biggest beneficiaries. We have already seen the FIIs shifting their weights in terms of moving from underweight to neutral or equal weight. I would go one step beyond and say that if you are able to contain the fisc and the current account deficit, we may see FIs getting into a slightly overweight position as far as India is concerned.
Arindam, what are your thoughts in terms of any sort of sectoral impetus that we could see tomorrow? There's a lot which has actually been spoken about in terms of infrastructure as well as oil and gas. If you had to bet on either one of these, which one would you think would have higher incentives tomorrow?
Well, clearly, I think the sector that is going to be keenly watched is going to be the infrastructure and capital goods, because that's been one sector which has been facing severe headwinds for the last couple of years. And here we must again understand that there are two aspects to the sector. One is you have the structural issues, and you have the cyclical issues. Now, cyclical is something that you really cannot wish away, which is typically your build-up in capacity, higher inflation, higher interest rates, etc. But I think what is far more manageable and can be really executed on the ground is an intent to try and see how we can remove the bottlenecks that are there in the structural area. The balance sheets of most of these companies, of course, have also been stressed out because of a prolonged period of elevated interest rate. I think what the government really can pull through is building out a robust PPP model, which would also ensure that, excuse me, that over a period of time we get in long-term flows coming in and kickstart the entire sector. Which would also mean that we need to kind of develop the corporate bond market, but I think that has been on the offing for quite some time. So this is one sector where I think a lot of attention is going to be focused on, and I would really hope that there are specifics which are really announced in tomorrow's budget.
How are you positioned on oil and gas now? There is an expectation of an increase in the import duty on crude, and that's made some of these oil and gas companies a little nervous. How would you go into the budget with your expectations there?
I think they have had a fairly good run. My sense is that this is again wishful thinking, but I think if some kind of a subsidy sharing formula to kind of address the under-recoveries that we are seeing can be worked out, I think that's going to give a lot of fillip. Also, I think if there is some kind of a mechanism which allows pass-through of higher gas prices, I think that will kind of help higher allocation into gas exploration going forward.
All right, that's the view coming in on the oil and gas space. Arindam, thanks very much for joining in this afternoon. It has been quite a critical afternoon of trade actually.